Welcome to Your Pathways to Wealth, the podcast where we explore what wealth truly means, because it's different for everyone. I'm Charles Massimo, and along with my partner Peter Anastasian, we'll dive into strategies, stories, and insights that help you define, grow, and enjoy your wealth on your terms. So let's navigate this journey together.
Join Charlie and Peter and their guest experts as they venture to help you continue to grow your wealth.
Peter, the other day I got an email from a client I shared with you, and he's a very successful and very sophisticated client. But the question really started me thinking, do people really understand bonds? The email simply said, "Hey, Charlie, I heard that I could swap out my T-bills for a 5% municipal bond." And I responded with a lot of questions. But again, it had me thinking, bonds are one of the least understood investments by the vast majority of people. So hopefully we can unravel some of that today when we talk to our clients. Peter, would you think the same thing, that bonds are one of the most complicated things to understand?
They definitely are. I mean, certainly you would expect it to be more of the simple type of investment, but there are a lot of moving parts that I think people truly don't understand, and we'll definitely dig a lot deeper into it today.
I think the first thing when we talk about bonds is, why do we use bonds and how do we use them? So the first thing I usually tell clients is that when we buy fixed income, one of the main reasons why we buy fixed income is to mute volatility and manage risk. Now, in equities, we expect volatility. It's just what the markets do. They go up or down. But in bonds, we don't expect, nor do we want, volatility when we own fixed income in our portfolio. So how do we avoid that? Well, let's first tackle the issue of long-term versus short-term bonds. And Peter, we always opt for short-term bonds. Now, people may disagree with us, but that's our philosophy. Why don't we talk a little bit about why we do that? Peter, what's really one of the first few reasons why we opt for short-term versus long-term bonds? But first, when we mean short-term bonds, we're talking about anywhere from 1 to like a 3 or 5 year maturity.
Yeah, I think the reason why we sort of gravitate towards short-term bonds are for a variety of reasons. For us, number one, liquidity is very, very important. And so we always want our clients to feel like they're in a position of strength and not necessarily in a position where they're susceptible to markets. And the same volatility, as you mentioned, Charlie, it's similar in the fixed income market as well, especially the longer term you go out. And so staying short term gives the investor definitely the ability to call the shots, and knowing that these dollars are coming up to maturity, and certainly have a lot less volatility because the money is just coming due in a very, very short period of time.
Yeah, now let's talk about that volatility issue and where they come in when we talk about bonds. So the first thing we have to look at again is maturities. Now, the longer you go out in the maturity, the more sensitive they are to interest rate increases or decreases. For instance, in 2022, when T-bills or bonds went from almost paying nothing to 4% almost overnight, if you were holding a 10-year bond, you may have lost 30 to 40% of the value of that bond. And now you were forced to holding that bond to maturity. Not only were you forced to holding that bond to maturity, but now when everybody else was getting 4%, you just locked your money up for 10 years, getting 1% or possibly even less for the safety. So again, I think the first thing we need to think about is where and why that volatility occurs. And again, the second thing is when you own short-term bonds, it's almost like owning cash. In that same example, when interest rates fluctuated from almost 0 or 1 to 4%, if you were holding a bond 1 or 2 or 3 years out maturity, you really weren't affected because those bonds are coming due in 1 to 3 years, and you could turn that into the higher yielding bonds that the market currently is showing. So again, Peter, I think people need to understand where that volatility and risk comes from.
Yeah, and again, to that point, with that volatility, as you mentioned, we heard many publications and articles come out over the past several years and saying the 60-40, 60% equity, 40% fixed income portfolio is dead. right? You'll never do well in it and so on. And we always said you should put an asterisk next to that, because if you're in short term or holding short term bonds, truly, as mentioned, you're in a position of strength. As those rates went up, you were capturing those rates along the way. But Charlie, to your point, if you purchased a 10, 20, 30-year bond, you certainly would have had to hold that position now, and you're sort of married to that position for a very long time, and or be subject to a big market decline in a rising interest rate environment. So to your point, as mentioned, client came to us saying they could get a 5% coupon. I think the first step is to understand what that means, right? A lot of bonds are issued at par. So for every bond, you pay $1,000 per bond, and they are issued at a certain coupon. So that coupon, let's say 5%, that 5% is what they're going to pay on that $1,000 bond. But it's all predicated on where interest rates are. So if interest rates are actually higher, that bond price is going to be adjusted accordingly. So you're not purchasing the price at $1,000, you're actually purchasing it at a different price, even though the bond is still paying a 5% coupon. So we always tell clients it's very important to understand what yield to maturity is, because that's probably one of the most important areas to focus in on bonds, because that's your actual rate, as well as duration. And duration really comes down to the risk that we spoke about, which is if you have a bond that has a 4% duration, that means for every 1% move in the bond market, there's a 4% adjustment in price, whether up or down.
Yeah. And again, we're starting to throw terms out that I hope people are starting to realize bonds are not that simple, because as Peter mentioned, yield to maturity, it simply means what is your maturity if you hold the bond to the date it matures. That's why sometimes the coupon is a little bit irrelevant. And the thing you got to think about, bonds aren't free. So when you're buying a bond, they're marked up one, sometimes two times before it goes to you as the investor. So you're automatically losing. It's kind of like the day you buy a car, you take it off the lot, the value is lower. You're not selling it for the same value. The bonds work the same way. If you buy a bond, the next day pretty much it's lower because of the markups. Because let's face it, the bond desk, what we call the bond desk, whomever's selling that bond out to the investors, they need to make money as well. So there's all this terminology that you got to be really careful about. And again, we're only talking about straight type of government T-bills, really safe bonds. We're not even getting into corporate bonds, which for many reasons, I am not a fan of, and we could talk about that at another time. But again, we're talking about these safe bonds. And even with safe bonds, whether it's municipals or T-bills or bonds, you need to realize what the different variables are and what you're actually holding. The other thing about bonds, right, as you were kind of mentioning, is that they're not all the same. There's sometimes a lack of transparency when we talk about bonds. So Peter, I mean, I've known a lot of bond people that made a lot of money in the heyday at Merrill Lynch and Smith Barney. So when you buy a stock, the stock, if it's trading on the stock exchange for $10, you're buying it for $10. If it's selling for $11, you're selling it for $11. But the transparency isn't the same with bonds, Peter.
Yeah, I totally agree. I mean, there are a lot of bonds, and I think a lot of people got caught off guard, especially back in 2007, 2008, where not recognizing what they were actually owning, they owned a lot of unrated bonds. And so not only unrated, but also long term. And to your point, even going back 2007, 2008, or even most recently COVID, those declines in those fixed income securities were down easily 30 to 40%. And so you have to sort of really relate what you're actually receiving in exchange for where safe money is. And what I mean by that is, if you look at what the banks are paying now, let's give them the benefit of the doubt and saying they're paying 3% or so. The more you deviate from where the bank is offering its clients in a CD, the more risk you're taking. So as an example, if you're getting 4% versus 3%, I mean, it should be a fairly decent and safe type of investment, but you certainly have to dig a little deeper beyond that. But if someone's offering you 8 or 9% in a fixed income security, where the alternative is 3%, you have to really question that and understand how much risk you're really taking.
Yeah, and that whole premise of chasing yield, people look at a bond or a bond fund and say, "Wow, this is paying 9%." To your point, it's paying nine, as an example, 9% when the market maybe is only 5 or 6 because they're taking on so much risk, or there's something called leverage where they're borrowing money to buy more bonds. These are things you need to really, really watch out for. So again, risk is paramount when you're buying fixed income. So chasing for yield is probably one of the worst mistakes an investor can do, because when you chase for yield, eventually it's gonna catch up with you. So again, when you're buying fixed income, you're buying it for safety, not for chasing yield. And when Peter and I build portfolios, again, we're building it with the pure reason of fixed income is to minimize the volatility of the portfolio. We're taking zero risk when we buy our bonds. Now, certain times in markets, maybe that hurts us because yields are better going long term. But again, at the end of the day, it's all about managing risk. So there are certain risks we can eliminate. So one of the easiest risks to eliminate is, again, by staying short term versus long term with your bonds. That's the easiest way to eliminate risk, and really think about your bonds as another way of owning cash. Now, Peter, last thing we want to touch on is individual bonds versus bond funds. And we could go either way on that. There are advantages and disadvantages to both.
Yeah, listen, and they both serve a certain purpose. Individual bonds, you sort of know what you're purchasing and you know what you're going to end up with, or you should know what you're going to end up with. Whereas in a bond fund, depending on where rates are and the type of environment, could add a lot more benefit to you or not. So in a rising rate environment, depending on the maturities that are in a bond fund or a declining interest rate environment, you could sort of lock in rates that were already purchased, 6 months ago, 3 months ago, and still have some time to go. Whereas going out and shopping out for a brand new bond, you're sort of adjusted for the market right away. So you have to really understand the benefits. But diversification, I think a lot of people underestimate, and that plays a key role in looking at a bond fund versus individual bonds themselves.
Yeah, and again, they're not mentioning names because you're really not allowed to make any recommendations necessarily of a bond fund. But there are bond funds out there, municipal bond funds, that were paying very high yields. If you peel back the layers, you started to understand why. And when rates went up, these bond funds went down about 50%. And what you have to realize, like a stock fund will come back. A bond fund, once it goes down, it's not coming back. So you're stuck with a loser for a really long time. So these, again, are things that you need to understand if you want to buy bonds. Again, we always believe that if you want to outlive your money, right? If you want your money to outlive you, you have to own a lot more equities than fixed income. But there's always a purpose for fixed income, or most times there's a purpose for fixed income. You just need to understand why and the role it plays in your portfolio. So, Peter, before we end it, any parting shots that you'd like to give here?
Again, I think it goes back to our adage that we always have, which is, keep your investments simple. And so don't try to overcomplicate things. Really understand what you own. If you don't understand it and you're hearing your friends or family members speaking about something and you just want to inquire about it, certainly you should ask, but doesn't necessarily mean it's always the right thing for you. So build around your risk profile, your risk tolerance, and that's what we're here for. We're here to help you and guide you along the way.
Yeah. And again, we have a great white paper on fixed income. If you like it, you could just email Long Island at wealthenhancementgroup.com, and in the subject line, just write bond white paper, and we'd be happy to send it to you. So until next time, appreciate, as always, listening. And if you need any further advice on fixed income or any type of investing, feel free to reach out.
To connect with Charlie or Peter, visit them at yourpathwaystowealth.com or call them 631-777-1030. That's 631-777-1030. The material and the opinions voiced are for general information only and are not intended to provide specific advice or recommendations for any individual or entity. To determine what is appropriate for you, please contact your financial professional.